afternoon, everybody. Welcome to TraderMerlin Show. It is your... We're on Tuesday. It's Trivia Tuesday, by the way. I have a residency. Oh, I got to button the shirt over here. It's getting hot. Residency, I guess, starting at a local place down here in Southern California. I'll be doing trivia on Tuesday night, so that should be a lot of fun. So if any of you are in Orange County and want to challenge your brains, let me know. Another quick shout out. I have a quality control department, as you guys may know. I have a compliance officer who runs in the silent backgrounds of this show. His name is Ed. He lives up in San Jose, and Ed is very good at finding any little thing that I say that's incorrect and bring it to my attention. I did shockingly make a mistake twice on the same thing, and I know that I just must have been going so quick when I said it that I messed up. And the mistake was that the Snapdragon chip, I said Broadcom. It's not Broadcom. It's Qualcomm is who makes the Snapdragon chip. That gives them the lead with that in that space. Now, where I was getting confused was because Broadcom is actually working with Apple and other companies on 5G chips, and they do specific ASIC chips, which are application-specific integrated circuit chips, on a customer-by-customer basis. So I would definitely, a big mistake there. So thanks, Ed, for catching that and always bringing it to my attention. I do appreciate it. He said he let it slide the first time, but the second time he couldn't do it. Hey, let me know. Sometimes when I'm going off the cuff, because I hope everybody appreciates this. Ed, I think you're a podcast. Yeah, you're a podcast guy. You know, there is no script here. I don't rehearse any of this stuff. It's all as we go, and I'm bound to make some mistakes. So I appreciate you catching me, and I always like correcting my mistakes. So there we go. There. Yeah, I know. No, the trivia one's gonna be fun, man. I love doing trivia, and it's funny because I like to dummy down my trivia because I make it so hard that people don't want to do it. So I've made it nice and somewhat easy. There'll be challenges for sure. All right, let's talk about the topic du jour, which is just shocking, the earnings season blowout. Now, as you guys can tell by the AI, only one of these logos is actually real. I told Midjourney to create me a wallpaper full of company logos, and I thought, man, this is a pretty awesome set of logos created here. But only one of them is real, and that's the JP Morgan in the middle. So, what's so shocking about this blowout? Let me ask you guys, type into chat what you think, and of course you're going to be biased now because the title of the show. But I went through and I ran through all the companies that reported last week, as well as the companies that reported so far this week. So we got Monday and Tuesday companies reporting. And I went through and I picked the companies that were $50 billion and higher, right? So pretty much big cap companies or bigger cap companies. What percentage of the companies that have reported that are $50 billion market cap or higher, what percentage beat their earnings forecast for this quarter? Type in the chat what you guys think. These numbers always fluctuate wildly, but you usually don't get when it's really pegged to one side or the other. And I was a bit surprised what we saw last week when 100% of them reported last Friday beat earnings expectations. We saw a nice positive reaction to begin with, but the way that we finished on Friday had me thinking that the markets were going to go and react in a negative way, which is why I took losses yesterday. Fortunately, made some of it back today on that breakout of the QQQs above yesterday's high, which is great. But I'm just kind of dumbfounded at the quantity of companies that have been breaking their earnings forecast. Now, I mentioned what happens typically in bearish market situations. Every company drops their forecast, and they keep dropping and dropping until pretty soon, it's like we're looking at the 400-meter hurdles, but the hurdle's 1 inch tall. Like, yeah, okay, you're going to jump that hurdle, no problem. And that's part of the reason why they're beating, but there still are quite a bit. So what I got here, I got 42%, 80, 85, 70, 93 for Les, 80% for Dwight, 83 for Mitch, or for Mike, and 70% for Skilled Stocksman. The answer is 94%. There's actually 16 companies that are $50 billion or higher that have reported since last Thursday, and only one has missed. That was Progressive Insurance. So Progressive Company missed their earnings. Everybody else has beat. I'll show you the earnings announcements that happened out there for today, just so you guys can see the good news that's kind of poured in today's session. And again, big banks were a factor in this. You had Bank of America beat earnings. They beat by about 5%. Morgan Stanley beat by about 8%. Synchrony beat by 8%. As I scroll down here, everybody on this page beat earnings. Now, not all of them had positive returns, right? Not all of them had positive returns, but I just really kind of shocking to see them beat that well. And actually, This goes back to my article that I wrote for barchart.com, which was Charles Schwab. And Big Eb, I hope you're still holding that Schwab had a hell of a move today. 12.57% jump up in Charles Schwab. They beat earnings, but they also made very positive comments, lining up exactly with what I was talking about in my article, which was this bank issue really didn't impact them at all. And that's kind of what I thought would be for the long term with them. Let's look at Charles Schwab real quick before we dive into our top 7. Here's Charles Schwab. Nice jump up today. Kicking myself. I sold the puts on it. I never actually took possession of Charles Schwab, which is unfortunate. Excellent. Big beers are on you when I come to San Diego. Yeah, that's a nice pop today. That'll certainly help the account. $7 jump up. Yeah, I was kind of bummed. I meant to buy some, and I was like, no, I'm just doing too many other things. And lo and behold, we had a nice move up in that one today. But that goes back through this whole earnings season blowout. And, as we look at this calendar going forward, I'll just run through some names coming up in the next couple days. Obviously, tomorrow is the big one. You guys still have till the end of the show to convince me to hold or unload my puts on the puts I sold on Tesla, which we'll talk about that here in just a minute. But tomorrow, look, huge day. I'll sort by market cap here. You've got Tesla, which if they pop tomorrow, man, they could break $1 trillion market cap by tomorrow. I mean, that's how crazy Tesla could be. You have ASML reporting, Netflix, you have IBM, Goldman Sachs, US Bancorp, and that's just tomorrow. There's even more big companies reporting later on in the week, such as Taiwan Semiconductor, Johnson & Johnson, Abbott Labs, Philip Morris, Intuitive Surgical, and the list goes on and on and on. So, a lot of times I try to anticipate what markets are going to do, and as you guys saw, I was wrong on Monday. It happens, fine. But I was reading the price action and the price behavior of how they responded to earnings. That's really why my trades were made on Monday. If I followed my rules, I really should not have made that short trade on Monday, but I did. Just didn't wait for it to break below my entry price, and that I paid for that one, and we made up for it today. But all in all, this earnings season looking very good. And again, if everybody's beating earnings, that might continue on, right? I think that's going to continue for the rest of the earnings season. We're going to start to have a lot more earnings beats. And that begs the question, are we going to get to all-time highs? So, my forecast at the beginning of the year was first quarter strong, second quarter flat, third quarter and fourth quarter sloping down, ending the year negative. That could be very wrong, especially if you look at where we are at right now on the S&P 500, right? I'll put a vertical line starting on January 1st just so we can see where we've come from and what that hypothesis looks like. Here is January, the first trading day of January, which was the 3rd. And from the opening of this year's trading to where we are today, that S&P 500 is up roughly, give me my numbers, Merlin, roughly 20%. Actually, it's just a hair less than that. 19.18% right now at this point for the S&P 500, which is phenomenal. Now, let me put a poll in here just because I haven't done one in a while. So I'll do a poll, and that poll is going to be, and don't worry, it'll pop up here in just a second. I'm just talking as I type because it's easier for me. Will the S&P 500 at all-time highs this year? And boom, there's the poll for you. The poll is, will the S&P 500 break all-time highs this year? Now, just so you guys can see before you make your opinion, how far away we are from that all-time high list, right? The all-time high we had was back in January of 2021, actually December, January. Let me give you the exact date. I want to make sure I have exact numbers here. I'm zooming into this peak we have right here. The all-time high on that was January 4th of 2022, that high price being 48.08 and a quarter. So if we go to that that price, how much of a gain would that be for our markets from current levels? And I will put, I'll try to draw it in here for you, just so we know exactly how much this market would have to move to get there from where we are right now to that level, 48.04, rough, there you go. It's about 4.6%. So this market only has to go up 4.6% from here to break all-time highs. So I'm just going to leave that out there for you a little bit, just so you guys can use that when you assess your response to the poll here, which is the S&P going to break all-time highs this year? Honestly, given what's going on with this earnings season, just the way things are headed, and the fact that the data is starting to look better for the economy, I have to throw my hat in the yes column. I have to go through and it just feels like that's where we're headed. The momentum just feels unstoppable at this point. I have a couple viewers who disagree with that, and they commented on the YouTube channel, which is cool. I will get to that here in just a second. We'll talk about some of the factors as to why you believe that they may not reach the all-time highs, but it just looks strong as can be right now. You know, I wanted to go short. I really wanted to go short. My bias is short, but today, when we broke the highs of yesterday on the triple Qs, just didn't question it. I just bought it, went with the momentum, and we had just nice moves up all day. The after hour gave back just a little bit, but we'll see if that continues. Big Eb says the rebalancing did not seem to hurt Microsoft today. No, technically it goes into effect on Friday. So there's still a couple days left, but it doesn't seem like it's impacting at all, does it? Kind of strange, because theoretically they have to sell Apple and Microsoft, but if you look at those two shares, let's bring that up here. Here's Microsoft. Yeah, strong like bull, Tatanka, right? No big deal there. It's actually up almost 4%, which is part of the reason you saw this NASDAQ rip. And then here's your Apple. Remember, these are the two that are supposed to be not liquidated, but having their positions cut in that S&P or NASDAQ 100. And here is Starbucks, one of the contenders that people are saying is going to have their portion increase. Well, they were down on the day by 0.17%. Another one that's going to potentially be in there would be AVGO, which is Broadcom, which does not have the Snapdragon chip. That was for you, Ed. You know, you have a Harami formation today on Broadcom. That's one that's supposed to be added in. MDLZ, not added in, have additional weighting in the index. They're already in the index, but have their position changed. MDLZ was another one, and these were just barely up. So really the whole market today driven by the big tech names. Again, Microsoft. You had Apple, which was down just slightly. Here's your Google, was down just slightly. It's funny because if you look at who's driving this, it's not Apple, it's not Google. Amazon down on the day. You can look at Meta, right? Just barely up. But thank you, Microsoft, for your 4% gain. And given your fact that you're so heavily weighted in the NASDAQ, single-handedly pulling this market up today. So kind of crazy. All right, let me see what the poll was. At least the results of this poll. And that poll, will the S&P 500 break the all-time highs this year? 53% of you said yes. 46% of you said no. The real answer is, who cares, right? It's going to do what it's got to do. And just right now, the momentum's to the upside. Long is where you want to be. There's a lot of talk about short squeezes going on and different scenarios like that. But it's just, to me, it's the data. You've got earnings coming in great. You've got economic data looking good. You get the Fed backpedaling a little bit on their raising rates. So, yeah, looks strong from here until it doesn't, right? Trend is your friend to the bend at the end. So let me look at a couple of different questions or comments, at least so we can discuss this as a group. Les says, I do agree with you that the Fed does not need to raise rates at this point, at this month's meeting. However, Powell did say that he would be raising at this meeting. Actually, I don't think that he said he's going to be raising at this meeting. I believe he said that we, the committee, believe that there may be another rate increase by the end of the year. I don't think he specifically said at this meeting. But I agree with you, Les. You do have till the end of the year. It's just, what's the right thing? Is it right to juice the markets again? Juicing the markets would be pausing, right? If they pause, I think you'd see this market just rip to the upside and maybe break all-time highs at that point. But I don't think he feels like he's on the hook. I think Powell knows that if he doesn't raise rates again, that the markets will rejoice that and look at him as a hero, that, hey, he's fixed the problem. He doesn't need to keep raising rates. Everything's good. And that will actually be better for the markets if he pauses. If he raises, that still puts unforeseen pressure down the road with a rate increase. So, yeah, they did say they're going to raise by the end of the year, or they foresaw another rate increase by the end of the year. But I don't know. I feel like that data is changing. I'm definitely the black sheep right now, because if you guys remember, we looked at that FOMC or Fed Funds futures. Those numbers are looking very, very positive, like you're going to see a rate increase on the 26th. Here is the actually of 7 days left to that meeting. They've got a 99.8% chance. I'm a 0.2% probability at this point that we're going to keep it the same at that July 26th meeting. So obviously there's a wealth of odds against me at this moment in time, but it just seems like the right thing to do. And I'd love to see from Jerome Powell the logic as to why they feel like they need to keep on raising rates. If inflation is literally on a 45-degree downslope, GDP is slightly increasing, and unemployment is barely rising. I mean, those are all factors that should keep that rate right where it's at for now and see if there's any pops in those 3 data points I just measured. If they continue their current trajectory, leave rates right where they're at and maybe even start to cut by the end of the year. But we'll have to wait and see. Really, what's going to be great is the announcement itself, which I think could be a shocker, and the press conference afterwards. Lisa says, I saw Yellen on Bloomberg and she said there wouldn't be a recession. What was your thoughts on that one? Well, I don't know. I mean, I'm tending to agree with them. You know, it's what I don't get with this market is how you can pump that much money into it and not have repercussions. There's always going to be a flip side to this massive injection of capital into our markets. We're seeing, you know, whether that's the tax stuff and all the infrastructure bills or all the stimulus checks that are going to people and flooding the markets with all this free money, whether that's the non-repayable loans, which is not a loan, that's a gift, right? If you never have to pay anything back, that's no longer a loan, that's a gift. The gift the government was giving all these businesses so they could survive COVID and all that flooding the markets, plus having interest rates at pretty much zero for the better part of 6 years, you know, those are pretty significant factors that will skew an economy and the way that an economy is surviving and functioning. So you have all this influx of capital. While it's great for growth and it gets growth going, at a certain point when we cut off that spigot of capital, where's the growth going to come from? Where's that stimulus that's going to further push these markets forward if we don't have it, right? If we're not putting in $15 trillion in two months like we did in 2020, where is that money going to come from to push these projects, businesses, spending, expansion, growth, R&D, development, and all that stuff? Where's that money going to come from to push it higher? So I feel like there is a recession coming. I just don't know when it's going to come. You know, it just seems improbable that this is going to grow like this without any problems, any pullback, any recourse at all. It just seems a little suspect to me. But for now, it's working. And all we can do is ride that current trend. Most of the major losers I've had this year have been going short, going against the market. So that's what it is. The comments pal makes at 230 will be the market mover. Totally, Les. Absolutely. I mean, that's the one you're glued to, right? The announcement itself, the market does a quick little whipsaw. I mean, that's why I created this popcorn graphic. This is what the announcement looks like. It does that. But then once the press conference happens, it's a whole nother huge set of waves. And that's when the markets really formulate their opinion on what Powell and the Fed are going to do. The VIX is getting to interesting levels. Well, I don't trade the VIX anymore because I think it's personally broken. After we have the 2008 financial crisis, I really don't use VIX. But you could look at it here. The fact that we're getting lower and lower and lower, right? That represents complacency, right? When the VIX gets really low, that means that people aren't even worried at all. If we do get down to single digits, like if we get down under 10, I will load the boat long on the VIX. I don't usually trade VIX. I've done some stuff with some of the ETF pieces on it in the past, but I will go heavy into the VIX with derivatives, with whatever I can if we get down below 10 on the VIX. So mark my words, we're getting kind of close. You know, a rally through an all-time high is certainly going to push this thing lower. Notice the amount of times. Let's go to a weekly. Here's your weekly chart of the VIX. Apologize for those of you that are listening to the podcast, you can't really see this. But if we go back, hell, I'm going to go monthly just so we can see the long-term impacts here. I have data going all the way back into 1990. And the amount of times that it's actually broken below the number 10, it broke it back in November of 1993. It broke it back in December of 2006. It stayed below it for several months back in 2017 and early 18 and hasn't been back since. Now, notice that it seems that after we go down below 10, you see there's always these huge surges up in the VIX, and that is typically where a market crash comes in. So I'm with you. I do think that VIX is getting really low. I'm definitely looking at that 10 level. If we get down below 10, I'll have no problem buying those VIX pieces because historically, it shouldn't be there. Historically, markets don't stay that overbought or that euphoric for that long before they come ripping back. And I don't necessarily need to go all the way up to, go from 10 to 90, but if I got to go from 10 to 40 in a very short period of time like it did here in 2018, great. Good opportunity there. Let's see. Jay Patel says, Yield curve inversion continues. Yes, it does. And the NASDAQ is inching towards all-time highs, is indicating a high risk of a recession. Well, historically, when you have that inverted yield curve, it does, right? It's almost a 100% success rate that when we have an inverted yield curve, there's a recession coming. Well, you know, if we look at this yield curve right now, and we'll look at both. We'll look at the 10-2 and the 10-1, which are two different metrics. I mean, this is your monthly here. That monthly is showing you that it's getting worse and worse and worse. That separation between the 10-year bond and the 2-year note, it's almost 1% right now. And if we look at the 10 versus the 1, it's 1.5%. I mean, this is insane to have that big of a discrepancy between a 10-year investment and a 1-year investment. So textbook-wise, right, and that's all we can really go off of here, textbook-wise is it's going to have a recession at some point. But right now, man, it feels like roaring 20s right now. It feels like all caution's been thrown to the wind. I mean, look at this is a monthly of the NASDAQ. We have had 1, 2, 3, 4, 5, 6, 7 months in. We've had 1 month that was barely down, just barely. Other than that, every month is a significant gainer for the NASDAQ. We saw January was an increase of 10%. We saw February, it's only down 0.66. Next month, big increase of 10% again. You get 10% month after month. That's crazy. In April, we only had a 0.35% gain. So that was one of the weakest of the year. 7% for the month of May. We're right up there when we get to the month of June, right? June, you're talking a 7.35, and we're already, halfway through July, and we're already at 4%, and we're ripping towards those highs. So, I mean, momentum right now says we're going to break it. It's just my gut and experience tells me we're going to have some pullback here, but we have not had it, and that's been costing me some ducats, costing me some money. I mean, this daily chart is phenomenal as well. So, will there be more bank failures? I think so. I don't think it's going to be widespread. I think that most of it right now is being shored up. But if you look at the models that banks do, they borrow short term, they lend long. So when they're lending long term and lending out money, they're technically losing it. And when this yield curve inverts as much as it has, it makes it even worse from their profit margins. So I'm pretty sure that what we're seeing right now is the Fed going into all these banks, making sure that there is liquidity, making sure there is some solvency, and that they can pass some stress test measures. We heard Barr talk about increasing some of those standards for regional banks as well, which hopefully will get implemented here soon. But out of the grand scheme, financial system, there's bound to be a few more others. I don't think there'll be the giants that we experienced back in the previous one with First Republic and Signature, Silicon Valley Bank, etc. But yeah, I think the possibility is pretty high that we'll have some other bank failures, and that'll probably just do what it's done historically, which is push some of these banks, when they do go under, they'll get consumed by the big firms. Again, we looked at Wachovia purchased by Wells Fargo when they went under, and then you have Washington Mutual got purchased by JP Morgan in 2000, and I think it was 2008 or 9 when they actually made the transaction. So it's a new world of trading, crazy. It is. It's just a different environment, which is why I love trading. And we talked about algorithms and AI the other day, and I have a problem with strategies and backtesting because we're in a different environment right now. It's a different market. And again, the trend is your friend till the bend at the end is that mantra I will live and die by with the financial markets. So at this point, you got to stay long, even though my bias and gut tells me we're going to be hitting some skids here. I think you guys still stay short, or still stay long, excuse me. Best way to trade the VIX. I like the derivative products, the VXX, and there's a few others that have different qualities, but you can go look at most of you. Let's see, let's go V. All right, so that's the short-term VIX ETN. That's the VXX, but there's a lot of other ones. Yeah, look at that chart. You gotta love leverage assets. Yay. This thing, if it's split adjusted, it's split twice. Split adjusted, this thing was up over 1,200. It's currently trading at 23 from those peaks in 2020, because this, again, is the opposite of the markets. Markets have been just ripping and hitting all-time highs. We had a 4-for-1 split in 2021. Another 4-for-1 split in 2023. So this is looking pretty awful. But if those markets do hit the skids and start to sell off real quick, which they probably will at some point, things like VXX, and there's several others, UVXY. So this is ultra short term. So this is going to be a triple, if I'm not mistaken. So you have singles, doubles, and triples. These leverage ones are even more dangerous. Yeah, look at this chart. If we go back to 2017 and we look at split adjusted, this thing was like at $22 trillion. You've got to love that split adjusted. Look how many times it split, though. It did a 10-for-1 split in 2012, 10-for-1 split in 2013, a 4-for-1 split in 2014, 5-for-1 in 2000. It just keeps splitting and splitting and splitting, which is why a lot of people love these leverage ETFs. But remember, if they're going against you and you're like, oh, I can't go any lower, they'll just split it and it'll end up going to zero ultimately. So, yeah, they're very dangerous. They're not something you want to hold long term. But if we get to the point where we rip through all-time highs and I see VIX get under 10 and maybe one or two other qualifiers, I'll look to be buying. I don't think I'm going to do the UVIX. I'll do VXX. I don't know if I want to go the big leverage stuff like that. It's a little bit too crazy for me. All right, what else did I have? Naum sent an interesting question. It's totally off topic for what we're discussing right now, but I'll just go to it right now just so you guys have it. And I'm going to wrap up. I got just so much stuff going on. I'm going to make these shows a little bit shorter here. How do you know if low volume is bullish or bearish? Monday was low volume across the board, yet the market went up. So you don't really know. I don't use volume for that. I don't use volume as a bullish or bearish indicator. I look at volume as, how do I describe this? I want you to think of volume as the knob on your stereo. Let me ask you, if the knob on your stereo, which number matters? The really low volume or the really high? Does 0 matter or does 10 matter? Well, I mean, 0 matters if you want it really quiet. What really matters for me, though, is not the 0. It's the 10. It's when it's so loud, it's breaking windows and chaos ensues. So I look at volume in that regards, that really high volume, when volume is 2, 3, 4 times normal, that's outlier. That's showing you panic or outright euphoria. So if I have the market have a day like today, the last 2 days, where it's just been ripping, just straight up, it seems like all day, even though it's only 1% each day, it looked really bullish. Look at the volume associated with that. All right, let me go back here. Let's go back to daily. We'll look at two things. We'll look at the NASDAQ. There's your futures. Here's your triple Qs. Does any of that look like climactic volume? Like a volume of 10? If this is your stereo dial at the bottom? No. This is like, 4 or 5. It's kind of in the middle range. No big deal. So I really don't pay any attention to it. Even though yesterday's volume was slightly lower, big deal. Who cares, right? No big deal for this one. If you look at the S&P, same thing. S&P actually really low volume. I mean, notice it's been trickling down lower and lower. There might be, I don't think I can do it here. TradeStation has an average volume you can add in, which is really nice to see where we are relative to its historical average. But the volume has been drifting lower. And really ever since June, when we peaked out at roughly 2.5 million shares, futures contracts traded for S&P, we are now at 1.2. We're about half the volume we were in early to mid-June. SPY. Let's go to the ETF. Not SPOY, SPY. You notice that volume it's lower than normal. Now, today was higher than yesterday, but still, there's nothing shocking here. So I don't look at any of this as being a factor. Now, look here. I know it's hard for the people that listen to the podcast. I'm looking at the volume that goes to March 10th all the way through March 17th. Very elevated. I'd say it's probably double normal, right? That to me is the volume on your stereo at like 9. It's loud. That means panic. Now, it didn't bounce right away. We had like 5 aggressive down days, and all of a sudden it ripped out of there. So I like to look for those types of events. When you have a big move with climactic volume, that's important. A big move with no volume just makes me suspect, right? If I have a market move 5% in a day and volume is half normal, what that really means is people just backed away. You're going, whoa, hold on. They don't want to buy or sell. They're just kind of taking it easy. And liquidity is usually pulled out of the market, and you get much bigger moves. It's the big moves on high volume that are the ones that are important to me. But that's just the way I look at volume. I know some people don't look at volume. It's fine, but great question, Naum. Hopefully I answered that one for you. Let's see. Ooh, salary map. All right, I'm going to read this one because it's a long one. I apologize, it's a real long one, but I do want to get to it because everyone's viewpoints do matter, regardless of whether they agree with me or they disagree with me. That's fine. It's not about me being right. It's about me having an opinion, and I put my money where my mouth is, and I'll trade off my opinion, and I'll be proven wrong by the markets, not you or somebody else. So I love it when everybody has differences of opinion. So this is from Salary Map on YouTube. Thank you, Salary Map, for the comment. He says, I agree with you that the market should have pulled back today. Well, remember, that was for Monday. And the only reason I thought that it should have pulled back is the way we reacted on Friday. We had a very bullish week last week. We gapped up on Friday, great earnings, and all of a sudden the markets ripped lower. And I thought, oh man, that momentum, that should have carried through. Now, if we have a spectrum of 100% guaranteed pullback on that Monday and a 0% chance, I think I was probably at like a 65% chance based off of what I saw. So what? That 35% chance is what happened on Monday, and we saw the markets rip up. So totally fine being wrong with that. Cost me some money. It's fine. That's the life of a trader. Now, there are micro and macro things that the economy has to deal with. The minimum wage in California has jumped from $15.50 to $22. Okay, coming for fast food workers if it gets through the courts. But look, that will have an impact. But what you're also seeing is in many businesses, you're seeing those workers that were getting paid $15.50 and may now be getting $22. There's fewer of them because a lot of the companies are going to automated systems where it used to be I go to the counter at McDonald's and order from somebody and place an order with them. I walk in now and I just keyed into a kiosk. I've now removed one of those workers. So there's an area of efficiency there on the part of these businesses because of automation, and in the future we'll have AI. I mean, hell, we're going to get to a point in 5 years, watch. You will walk into a McDonald's and it's going to profile you and be like, hello, Mr. Rothfeld, would you like your Big Mac with double pickle and extra cheese? Like, how did you know I wanted that? Because the AI will know I ordered it last time. We're going to get to that point. Won't even need food workers. But anyway, I'll get back to the discussion. A few years ago, after 5 years of getting a degree in teaching certificate, my daughter got a teaching job at wage level. That will cut into earnings and also drive automation. That's on the macro side. While I agree with you that raising the cost for employment will go up, there's also they're raising the prices of their goods and services. I always use the example of the Habit Burger, right? It's gonna be on my tombstone. Will be the Habit Burger. He goes there every Friday. With the Habit Burger, even if it's in California and those employers got paid, or the employees went from $15.50 to $20, $22, the cost has already been recouped by the price of the food. They've already jumped up. Of course, that was done under the guise of inflation, but we've also seen that consumer price levels are falling, CPI numbers are dropping, and PPI numbers aren't falling anywhere near as fast, which means more corporate profits, and that's bullish for businesses going forward, and we're witnessing that right now in our markets. On the macro side, there is that little thing called trillions of dollars printed and the bonds sold to cover it. Correct. The interest on that should be reflected in the markets. And there is the issue of all these things got inflated that turns out wasn't transitory. So I don't see micro and macro things pointing to a strong economy and a corresponding market. But then again, it's manipulated to where the big institutions want it. Correct. I think what we're seeing is the markets adapt to that huge influx of capital. So, of course, we got the inflation out of it. Businesses all raised their prices. There's nobody lowered their prices. And I don't see them lowering their prices going forward. So what we have now is prices got jacked up to a certain level, and the cost of those goods and services are dropping for the businesses that sell those goods and services. So let's say the Habit, right? Certain inputs into their supply chain are dropping in price. We're seeing corn, wheat, soybeans, some of these other commodities. Maybe not olive oil, maybe not live cattle, those have been rocking, but we are seeing some of the inputs into their business model decline. Yet they've raised their prices and their profit margins are now going to be much bigger. The further that those commodity prices drop, the better the profit margins are going to be for these businesses. So, you look at somebody like Darden Restaurants or Yum Brands, these types of restaurants, Wendy's, their profit margins are probably going to start to get better and better as inflation declines because they're not going to lower the price of their square burger patties at Wendy's. So I don't think it's the inflation side of things. I think the big unknowns for Salary Map here and for me is what's the impact of those dollars, right? What's the impact of those trillions of dollars that flooded the market and the completely manipulated bond market? If that starts to fall apart, then I think that's our big problem. And again, I'm not anticipating it. I'll be reactionary because when I try to jump the gun and think, oh, now's the time to short these markets, well, I get my teeth kicked in. So I need to wait for the market to give me that proof that we're rolling over. I'll leave some money on the table, which is fine. But for now, even though, it looked like hell in a handbasket for a while, all of a sudden our market's looking better and better. And of course, you have to believe that data that's being put out there. But really, all I have to believe is these price charts. So let me start at the bottom, work our way to the top so I can wrap this show up. I didn't plan on going too long today. We had our 10-year, here's your 10-year, was down on the day. It's already in our new session here for Wednesday, but you had a hammer formation down near the bottom, which doesn't bode well for the equity markets. That was down on the day just a bit. I don't have the percentages because we rolled into the new hour. If you look at Bitcoin, not liking this. We are right at that red line I've had drawn there, which is at 29.7. We are sitting at it right now. Not good. I think if we break that, you could see some pretty big selling pressure in Bitcoin. Although we do have confirmation from the SEC that they are now acknowledging several Bitcoin spot ETF applications, and that is an extremely positive thing. But the market just seems to be shrugging it off. Dollar index, 0.07% gain on the day. Pretty much the same candlestick pattern as yesterday. So we're going sideways for the past 3 days. S&P 500 was your fifth place finisher. 0.75% gain, looking real nice. Again, we've had 8 days. 7 of those have been up. 7 days. 6 of those have been up. And ripping through those overhead supply levels, the question now becomes, where are we headed? Well, the obvious thing becomes this last turning point, which is right around 46.30. So you got another about 50 points before we get to that level, which may happen very soon, especially with Tesla's earnings and Netflix. NASDAQ, your fourth place finisher. Even as great as it was today, not the number one performer. You had a 0.85% gain for the NASDAQ. It briefly touched 16,000 today before pulling back. As you can see here, the futures for the NASDAQ 100 hit 16,029. So breaking through that 16,000 level, which is a pretty big milestone. But all in all, still only fourth place. Russell 2000, that took your lead. 1.25% was its rip to the upside. Now going to be questioning, does it challenge the upper end of this box that we had going all the way back into August of 2020? Your closest supply zone is real close at right around 2,000, just above 2,000. So I think we're going to hit that one fairly quickly, barring any bad news from our equity markets. Gold, 1.25% pop to the upside. Looks like my silver will be taken away from me on Friday. Okay, that's fine. I will do well with that one. I have one batch that I have $24 calls sold against, but everything else is going to get taken away at 21.50 and 22. Wait, is that right? Let me make sure. Yeah, 21.50 and 22 will be, 22 and 22.50 is where I'll be losing most of my silver, but I have one batch left at 24 up here at the peak. Gold was up 1.25%, closing at 19.80. Again, looking great. It ripped through that last point I thought it would stall at, so I can get rid of that line and get rid of this line. I can get rid of a lot of these lines. Now it looks like your next stopping point is going to be 2,000 for gold, which is another $20 higher from here, which is about another 1.2% gain from this level. All right, and lastly, crude oil. We had that big engulfing pattern happen on Friday, follow through with a nice down day on Monday. Well, now we've got a bullish engulfing pattern form today, which completely eats up yesterday's price action. That's a positive move for crude oil. We'll see if it can rally back, break these highs at 77.25, and that is your top 7 rundowns. Why did Microsoft soar 20 points earlier today? Gave some back, but I didn't see the news, Lisa. Unfortunately, I wasn't paying attention to Microsoft. I mean, I saw it. It came up on some of my watch lists, but you go here, probably some big headline news. Latest layoffs hit more than 1,000 employees. No, Teladoc. Yeah, not exactly sure why that was. Not exactly sure. My guess is it had something to do with the rebalancing, but it should have been the opposite effect, right? There should have been selling going on, unless they're increasing the weighting of Microsoft in the NASDAQ 100, which they're not going to do. It needs to be dropped from 12 to 9 or 10%. So drop that a little bit. All right, so you guys tell me. Here's Tesla. You got to give me the definitive what you want me to do with it. I've got TSLA. I have the 240 puts, which it rallied up again today. Do you think that I should close the puts? Right now, I'm in the money huge. It would have to drop over 18% on that announcement on earnings tomorrow before I actually was exercised. So at this point, I think I'm probably okay. So I could just leave it and continue to collect all the premium, leave it alone. That's one choice. The other choice is to close out the position. Going to cost me a couple bucks tomorrow and just take the profit, pay the commission. I'll probably give away, I don't know, $100 or so worth of commissions and residual profit that's still in it before, or I just leave it alone. What do you guys think? Should I just leave it alone, or should I close it out tomorrow? It'd have to drop 18.16% to even get to my strike price, and I'd still have made all the premium I collected. What do you guys think? Curious what you guys are thinking out there. All right, as you guys let me know what you think I should do with this one, since I'm going to keep it democratic and you guys get to do the votes. Here's, again, what we got cooking for tomorrow, as I mentioned. G33GS says, the only one who responded says, close it. All right. Remember, I'm going to give some of that. And it could move 20%, that's for sure. You have Tesla, you have Netflix, IBM, Goldman Sachs, Kinder Morgan, Alcoa, United Airlines, Halliburton, U.S. Bancorp, Las Vegas Sands, Crown Castle, Discover Financial Services, Citizens Financial Services, a lot of big companies reporting earnings tomorrow. So keep your eye open for that one. A lot of the big stuff is happening after market close, although you do have financials like Goldman Sachs reporting before market open, same with Halliburton. My options expire tomorrow, Les. Expire on Friday. They expire this Friday. So I'm at the point now where time decay is absolutely on my side, and it's just dripping down. It's a huge winner at this point. I basically collected all the premium. I didn't look at the percentage. It's up like 90-something%. So I run the risk of, my worst case scenario is I run the risk that this comes all the way back down 18% tomorrow. It opens up on Wednesday or Thursday or Friday, Thursday or Friday, it opens up down below 240, and I'm stuck holding the shares at 240, which I don't really feel that bad about. Think it goes up, but take half off. Close half the position. I got half. Roll my puts in the next month to collect more premium. Let it run. Oh, I see more let it runs. Let them expire worthless. Yeah. Yeah, if this was, maybe a month or two out, like let's say I had August, I might close it, but I think I'm 2 days away. It's certainly a big risk, but the probability of it dropping 18%, with Tesla, it could absolutely happen, although they've been dropping some good news lately. If over 90% close it, my rule, man. All right. I'm reading through them. I think that the majority, if I can get tomorrow's data, it looks like the majority say let it be. I'll go count. I'll tabulate them all, and the majority is going to win there. I have a feeling I'm going to let them ride because I got more let it. What's your comment above? Depends on if you want Tesla. I don't mind owning Tesla. I think I'm fine to own Tesla, but it's that old adage: fast nickels, slow dimes. I could guarantee all the premium I would collect if I close it out tomorrow. I run a little bit of risk. I'm still going to keep all the premium, but I run the risk that it falls 18% and I end up buying it. But all right, I'll tally it up and see what we got. Let's see. And last one is I got to run here. Here is your economic calendar for tomorrow. We do have some stuff to talk about, and that comes in the form of housing. You've got housing starts and building permits coming out tomorrow. You also have crude oil inventories. If you're trading the euro, you have some final CPI numbers coming out. Australia with their unemployment rate, and that's pretty much the big stuff happening for tomorrow. So that, my friends, is your show for today. I've got a few, Lisa. I've only got 5 at this point, which is not a lot, but still worth it. I think it ended up being like 10 grand worth of premium that time. I'll have to look at it, but. All right, that's going to do it for me for today. Hope you guys enjoyed it. I don't have any guests the remainder of the week since I never look for guests anymore. It'll just be me on the show tomorrow. Maybe I'll have a couple coming up here. Larry's out shopping for guests for me on the program. He's found some good people, which we'll probably have up in August. Some new people that you've never seen before, which should be fun. You want Jerry Baldwin on the show? All right, I can get Jerry Baldwin on the program. Only thing is, I just don't like when some people oversell their services, right? Give education to you guys, talk about markets, but I hate the hard sell. Buy this, take my class. That stuff kind of bugs me. But anyway, that's gonna do it for me, guys. I'm gonna go get ready for my trivia for tonight. Hope you all had a fun session. Hope your trading day went well. Tomorrow should be a fun one also. So I will see you guys for our Wednesday show with the results and the popcorn trade, which is Tesla reporting earnings after market close tomorrow with Netflix. I will see you all tomorrow. Take care, my friends. Have a fantastic remainder day.